Welcome to our beginner's guide to options trading. I'm here to take you through the basics of this powerful and versatile financial instrument. Options trading is a way to speculate on the price movement of underlying assets, such as stocks, commodities and currencies, or to hedge against potential losses in your existing portfolio. An option is like a contract that gives you the right, but not the obligation, to buy or sell an underlying asset at a specific price, known as the strike price, within a specific period of time, known as the expiration date. Think of it like having a superpower to control the stock market. Options trading can be a powerful tool for traders and investors. It allows you to potentially make a profit from both bullish and bearish market movements. For example, if you believe a stock will go up in price, you can buy a call option, and if the stock goes up, you can sell it and make a profit. On the other hand, if you believe a stock will go down in price, you can buy a put option, and if the stock goes down, you can sell it and make a profit as well. Options trading can also be used as a hedge against potential losses in an existing portfolio. It's like having a superhero power to protect your portfolio against market downturns. But before you start trading options, it's important to understand the mechanics of how they work and the risks involved. In this course, we will cover the basics of options trading, including the mechanics of buying and selling options, option pricing, and different trading strategies. So if you're ready to learn how to use options trading to potentially make a profit and manage risk in your portfolio, let's get started. Welcome to our lesson on the mechanics of options trading. In this lesson, we will be covering the basic mechanics of buying and selling options, including the different types of options, the role of the strike price, and the concept of expiration. Let's begin with the two main types of options, call options and put options. A call option gives the holder the right to buy the underlying asset at the strike price, while a put option gives the holder the right to sell the underlying asset at the strike price. The strike price is the price at which the underlying asset can be bought or sold, depending on whether it's a call option or a put option. The strike price is a key factor in determining the price of an option, and it can have a significant impact on the potential profit or loss of a trade. Expiration is the date on which the option contract expires. Once an option expires, the holder can no longer exercise their right to buy or sell the underlying asset at the strike price. This means that it is important to be aware of the expiration date when trading options, as it can have a significant impact on the potential profit or loss of a trade. Now that we've covered the basic mechanics of options, let's dive deeper into how options are purchased and sold. When buying an option, the buyer pays a premium to the option seller for the right to buy or sell the underlying asset at the strike price within the specified expiration date. The premium is determined by several factors, including the underlying asset's current price, the strike price, the expiration date, and volatility. Additionally, there are also different types of orders available for options trading. A market order is the most basic type of order. It is an order to buy or sell an option at the best available price at the time the order is placed. A limit order is an order to buy or sell an option at a specific price or better. A stop order is an order to buy or sell an option when the price of the underlying asset reaches a specified price. It can be used as a protective measure to limit potential losses. Let's delve deeper into what it means to sell an option. When someone sells an option, they are also known as the option writer. When someone writes an option, they are selling the right to buy or sell the underlying asset, at a specific price, the strike price, within a specific period of time, the expiration date, to the option buyer. In return for selling this right, the option writer receives a premium from the option buyer. An important aspect to understand is that when selling an option, the option writer has an obligation to fulfill their side of the contract if the option is exercised by the buyer. So if the buyer of a call option chooses to exercise their option to buy the underlying asset, the option writer would be obligated to sell the underlying asset to the buyer at the strike price. If the buyer of a put option chooses to exercise their option to sell the underlying asset, the option writer would be obligated to buy the underlying asset from the buyer at the strike price. It is important to note that when someone writes an option, they have a limited potential profit, the premium they receive, but potentially unlimited risk. It's important to have a solid risk management strategy when writing options, as well as proper understanding of the underlying asset, the expiration date, and the strike price. Additionally, the option writer may be required to put up collateral to cover their potential losses. This is known as margin. It's also worth noting that when someone writes an option, they are also able to close their position by buying back the option they have written. This is known as closing the position or offsetting the option. This allows the option writer to limit their risk and lock in their profit. Why is the strike price important? The strike price, also known as the exercise price, is the price at which the underlying asset can be bought or sold under the terms of an option contract. The strike price is a key element of the option contract, and it plays a significant role in determining the price of the option, and the potential profit or loss of the trade. For call options, the strike price is the price at which the holder of the option can buy the underlying asset. The holder of a call option has the right, but not the obligation, to buy the underlying asset at the strike price, within the specified expiration date. The strike price is set at the time the option contract is created and it is fixed throughout the life of the contract. For put options, the strike price is the price at which the holder of the option can sell the underlying asset. The holder of a put option has the right, but not the obligation, to sell the underlying asset at the strike price, within the specified expiration date. The strike price is set at the time the option contract is created and it is fixed throughout the life of the contract. When buying a call option, if the price of the underlying asset at expiration is above the strike price, the option holder will make a profit, by exercising the option and buying the underlying asset at the lower strike price and selling it at the higher market price. On the other hand, if the price of the underlying asset at expiration is below the strike price, the option holder will not exercise the option, and the option will expire worthless. When buying a put option, if the price of the underlying asset at expiration is below the strike price, the option holder will make a profit, by exercising the option and selling the underlying asset at the higher strike price and buying it at the lower market price. On the other hand, if the price of the underlying asset at expiration is above the strike price, the option holder will not exercise the option, and the option will expire worthless. It's important to note that the strike price also affects the price of an option. In general, the further away from the current market price the strike price is, the cheaper the option will be. Therefore, options with a strike price that is farther away from the current market price will have a lower premium than options with a strike price that is closer to the current market price. Welcome to our lesson on option pricing. a fundamental concept that is crucial for any options trader to understand. In this lesson, we will be covering the basics of how options are priced, including the key factors that determine the value of an option and how they are used in the pricing model. There are 4 key factors that help determine the value of an option: intrinsic value, time value, volatility, interest rates. Intrinsic value is the inherent value of an option, which is the difference between the current market price of the underlying asset and the strike price. For call options, intrinsic value is the difference between the strike price and the current market price of the underlying asset when the market price is above the strike price. For put options, intrinsic value is the difference between the strike price and the current market price of the underlying asset when the market price is below the strike price. Time value represents the value of an option that is not intrinsic, and it takes into account the likelihood that the underlying asset's price will change favorably before the expiration date. It is also known as the extrinsic value, and the time value of an option decreases as the expiration date approaches, known as time decay. It reflects the market's expectation of future volatility and the time remaining until expiration. Volatility is a measure of the fluctuation in the price of an underlying asset, and it is a key factor in determining the price of an option. A higher volatility means that the underlying asset's price is expected to change more dramatically, which means that options will be more expensive. On the other hand, lower volatility means that the underlying asset's price is expected to change less dramatically, which means that options will be less expensive. When calculating the price of an option, the volatility of the underlying asset is used to estimate the likelihood that the underlying asset's price will move favorably before the expiration date. Interest rates play a role in option pricing because options are often used as part of a larger strategy that involves borrowing or lending money. When interest rates are high, it is more expensive to borrow money, which means that options will be more expensive. On the other hand, when interest rates are low, it is less expensive to borrow money, which means that options will be less expensive. The interest rate is used in the pricing model as a factor to account for the cost of carrying an option position. So to summarize, the price of an option is determined by a combination of intrinsic value, time value, volatility, and interest rates. Intrinsic value is the inherent value of an option, which is the difference between the current market price of the underlying asset and the strike price. Time value represents the value of an option that is not intrinsic, and it reflects the market's expectation of future volatility and the time remaining until expiration. Volatility is a measure of the fluctuation in the price of an underlying asset, and it is used to estimate the likelihood that the underlying asset's price will move favorably before the expiration date. Interest rates play a role in option pricing because options are often used as part of a larger strategy that involves borrowing or lending money. Option pricing is a complex subject, and the prices of options can be affected by many different factors and variables. Keep in mind that option Greeks are also an important tool that can provide valuable information on how the option price would behave under different market conditions. Welcome to our lesson on option Greeks, an essential tool that any options trader should know. In this lesson, we will be covering the basics of the option Greeks, including what they are, how they are used, and how they can help you in making informed decisions in your options trading. Delta is a measure of how much the price of an option will change in response to a small change in the price of the underlying asset. It's a representation of how much the option price is correlated to the underlying asset's price, usually expressed as a decimal between 0 and 1 for call options and -1 and 0 for put options. It is also known as the hedge ratio because it helps you measure how much of the underlying asset you would need to hold to neutralize the option's price risk. Gamma is a measure of how much an option's delta changes in response to a small change in the price of the underlying asset. It's like the accelerator of the option price, It tells you how fast the delta changes with small price movements. Gammas are higher when the option is at the money, and they tend to get smaller as the option gets further out of the money or in the money. Theta represents the rate of decline in an option's price as time passes, also known as time decay. It tells you how much of the option's value is lost each day as the expiration date gets closer. It is important to consider theta when trading options with a short-term expiration date, as the rate of decay can be significant. Vega represents the rate at which an option's price changes in response to changes in volatility. It tells you how much the option's value will change with a small change in volatility. Higher volatility usually means higher premiums on options and vice versa. Vega is important to consider when trading options on assets with high volatility. So to summarize, the option Greeks are a set of metrics used to measure different aspects of an option's price, including delta, gamma, theta, and Vega. Understanding these metrics can help you make informed decisions in your options trading by providing valuable information about how the option's price may change in response to different factors. Delta measures how much the option's price will change in response to a small change in the underlying asset's price. Gamma measures how much the option's delta will change in response to a small change in the underlying asset's price. Theta measures how much the option's price will decline as time passes, and Vega measures how much the option's price will change in response to changes in volatility. It's important to keep in mind that the Greeks are not standalone metrics and they should be used together in order to understand an option's price fully. You can use these metrics in combination with other factors like underlying price, strike price, expiration, to adjust your trades accordingly. Also keep in mind that the values of the option Greeks can change over time. It is crucial to have a good understanding of how these metrics change in different market conditions and also to keep monitoring them throughout the life of the option contract. Let's talk more about how the Greeks are used to analyze and predict option prices. Option Greeks are a set of metrics used to analyze and predict the behavior of option prices under different market conditions. They provide valuable information about how the option's price may change in response to different factors, such as changes in the underlying asset's price, changes in volatility, and the passage of time. Delta, for example, can be used to gauge the sensitivity of an option's price to changes in the underlying asset's price. If an option has a delta of 0.5, it means that if the underlying asset's price increases by $1, the option's price is expected to increase by 50 cents. Similarly, if an option has a delta of minus 0.3, it means that if the underlying asset's price decreases by $1, the option's price is expected to decrease by 30 cents. Gamma can be used to measure the rate of change in delta, which helps to predict how much the option's delta will change in response to small changes in the underlying asset's price. When gamma is high, it means that the option's delta is changing rapidly, and as the underlying asset's price changes, the option's delta will change more quickly. Theta can be used to predict how much the option's price will decline as time passes. It can be used to predict the rate of time decay of the option, which helps to identify whether an option is relatively more or less expensive based on its time left to expiration. Vega can be used to measure how the option's price will change in response to changes in volatility. A high Vega means that the option's price will change significantly when volatility changes. This can be used to predict how much the option's price will change when volatility in the underlying asset changes. Using these and other Greeks together can provide a comprehensive picture of how an option's price is expected to change under different market conditions and can be used as a tool to make more informed decisions about options trading, such as hedging positions, adjusting strike prices, and managing expiration dates. Welcome to our lesson on volatility. In this lesson, we will be covering the basics of volatility, including what it is, how it is measured, and how it can be used in options trading. What is volatility? Volatility, is a measure of the fluctuation in the price of an underlying asset. It represents how much the price of an asset is likely to move up or down in a given period of time. Volatility can be measured in a number of ways, but the most common method is through the use of the historical standard deviation of the underlying asset's price. This is calculated using the standard deviation of the underlying asset's price over a specified period of time, usually the past 30 or 60 trading days. This method uses historical data to estimate future volatility, and it is based on the assumption that past volatility can be used as a predictor of future volatility. Implied volatility is a measure of the volatility that the market expects for a particular underlying asset in the future. It is derived from the market price of options on the underlying asset, rather than from historical data. It can be used as a forward-looking indicator of volatility, and it represents what the market expects to happen in the future. This can be very useful in predicting future price movements of the underlying asset. Volatility skew is a measure of the difference in volatility between options with different strike prices. It represents how the volatility of an underlying asset varies across different strike prices. Typically, options at the money will have higher volatility than options in the money. It's important to note that volatility can change over time, and it can be affected by different factors such as news, market conditions, and the underlying asset's price movements. Therefore, it's important to monitor volatility regularly, and use it as a tool in making informed decisions when trading or investing. Now let's move on to what we believe to be very important concepts for developing your trading strategy. Although we will not go in depth teaching specific strategies at this time, understanding what it means to be in the money and out of the money when entering an options trade is of great value. In the money options, ITM, and out of the money options, OTM, refer to the relationship between the strike price of an option and the current market price of the underlying asset. An option is considered in the money if the option holder would make a profit if they exercised the option at the current market price. For call options, this occurs when the current market price of the underlying asset is above the strike price, and for put options, this occurs when the current market price of the underlying asset is below the strike price. An option is considered out of the money if the option holder would not make a profit if they exercised the option at the current market price. For call options, this occurs when the current market price of the underlying asset is below the strike price, and for put options, this occurs when the current market price of the underlying asset is above the strike price. In general, in the money options have a higher premium, because they have intrinsic value, which means they already have an inherent value because the option holder could already make a profit by exercising it. On the other hand, out of the money options have lower premiums because they have no intrinsic value, which means they do not have an inherent value, and the option holder can only make a profit from the option if the underlying asset's price moves in the favorable direction. It's also worth noting that when an option is at the money, this means that the strike price and the current market price of the underlying asset are equal. The option holder does not have an inherent profit or loss by exercising the option. Now is a great time to review the pros and cons of these two very different option contracts. In the money options, ITM, and out of the money options, OTM, have distinct advantages and disadvantages, depending on the strategy and goals of the option holder. Advantages of in the money options. Higher likelihood of making a profit, because ITM options have intrinsic value. The option holder can make a profit by exercising the option or by selling it at a higher price than the premium paid. Greater intrinsic value. In the money options have intrinsic value, which is the difference between the strike price and the current market price of the underlying asset. This intrinsic value is the inherent profit that an option holder would make by exercising the option. Less sensitive to time decay. In the money options tend to be less sensitive to time decay, which is the reduction in value of an option as its expiration date approaches. This is because they have intrinsic value, which means they still have value even as the expiration date approaches. Disadvantages of in-the-money options. Higher premium. In-the-money options tend to have a higher premium than out-of-the-money options because they already have intrinsic value. Limited profit potential. The profit potential of in-the-money options is limited to the intrinsic value and the premium received. If the underlying asset does not move in the expected direction, the option holder may not make a significant profit. Advantages of out-of-the-money options. Lower premium. Out-of-the-money options tend to have a lower premium than in-the-money options because they do not have intrinsic value and the option holder can only make a profit if the underlying asset moves in the expected direction. Greater profit potential. Out-of-the-money options have greater profit potential than in-the-money options because they have the potential to gain intrinsic value as the underlying asset moves in the expected direction. Disadvantages of out-of-the-money options. Greater risk of loss. Because out-of-the-money options do not have intrinsic value, the option holder may lose the entire premium paid if the underlying asset does not move in the expected direction. More sensitive to time decay. Out-of-the-money options tend to be more sensitive to time decay because they do not have intrinsic value, which means they lose value as the expiration date approaches. When choosing between in-the-money and out-of-the-money options, it's important to take into account the underlying asset's volatility, the time until the expiration date, and the overall market conditions, as well as your risk tolerance and trading strategy. As a bonus, we will take a few minutes to discuss the concept of the bid, ask, and volume and the importance of each. Let's begin. In the options market, the bid and ask prices are used to indicate the highest price a buyer is willing to pay for an option, the bid, and the lowest price a seller is willing to accept for an option, the ask. The difference between the bid and ask price is called the bid-ask spread, and it represents the cost of trading the option. The bid and ask prices can change depending on market conditions, such as changes in the underlying asset's price, volatility, and interest rates. Volume represents the number of options contracts that have been traded during a particular period of time. It is used to indicate the level of liquidity in the options market, and it can be used to gauge the level of interest in a particular option or underlying asset. The bid, ask and volume are important indicators of market conditions and they are used by traders to make informed decisions about options trading. For example, the bid-ask spread can be used to gauge the cost of trading an option, while volume can be used to gauge the level of liquidity in the options market. Additionally, traders use bid-ask spread, volume and open interest as indicators of market sentiment, and to gauge the potential for price movements in the underlying assets. A high volume with a tight bid-ask spread usually indicates a liquid market with a strong demand for an option, and this can lead to a higher potential for price movements in the underlying assets. On the other hand, low volume with a wide bid-ask spread indicates a less liquid market with less demand for the option, leading to lower potential for price movements in the underlying assets. You may be wondering, what is a liquid market? I was hoping you would ask that. Let me explain. A liquid market is a market where there are many buyers and sellers, resulting in a high level of trading activity. This means that there are many market participants willing to buy or sell an asset at any given time, which results in the ability to buy or sell an asset at a fair market price with minimal price slippage. This is generally true for markets that have high volume and tight bid-ask spreads. A liquid market is characterized by a high degree of transparency, with prices that are widely available and consistent across different platforms, as well as efficient market clearing, which means that transactions are completed quickly and with minimal impact on the market price. This is due to the high number of market participants and the ease with which they can enter and exit the market. In contrast, an illiquid market is one where there are few buyers and sellers, leading to low trading activity, large bid-ask spreads, and difficulty in executing trades at fair market prices. These markets are generally more opaque, prices can be inconsistent and can be less predictable, and it can take longer to execute trades. In summary, a liquid market is a market where it's easy to buy and sell an asset at fair market price with minimal impact on the price. It's an important characteristic that traders and investors should consider when evaluating different markets or assets to trade or invest in. Welcome to our class on risk management. As traders, one of our main goals is to make a profit, but it's equally important to protect our capital and avoid losing all of our money while trading. Risk management is the process of identifying, assessing, and prioritizing the potential risks that we face while trading, and then taking steps to mitigate or avoid those risks. One of the key aspects of risk management is to set stop losses. A stop loss is a predetermined price at which we will exit a trade if the market moves against us. By setting stop losses, we can limit our potential losses on a trade and protect our capital. Another important aspect of risk management is diversification. Diversification is the process of spreading our risk across multiple positions, markets, and asset classes. By diversifying our portfolio, we can ensure that a loss in one position does not wipe out our entire trading account. It's also important to have a well-defined trading plan and stick to it. This means having a set of rules for entering and exiting trades, as well as managing our risk and adhering to our risk management strategy. Another key aspect of risk management is to stay informed and up to date with the latest market news and events. This includes monitoring any potential macroeconomic or geopolitical events that could impact the markets, as well as keeping an eye on any relevant company news or earnings reports. It's also important to be aware of the level of your own risk tolerance, which is the amount of risk you are willing to take on. In order to do this, you should have a good understanding of your own financial situation and goals. In conclusion, risk management is an essential part of trading, and by implementing proper risk management strategies, we can avoid losing all of our money while trading. Remember to set stop losses, diversify your portfolio, have a well-defined trading plan, stay informed, and be aware of your own risk tolerance. Welcome to our class on technical analysis. As new stock options traders, understanding technical analysis is crucial in making informed trading decisions. First, let's define what technical analysis is. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity such as past prices, volume and other market indicators. It is used to identify patterns and trends in the market which can be used to make informed trading decisions. The first step in technical analysis is to gather and analyze data on the underlying asset or security you're interested in trading. This data typically includes historical price and volume data, as well as other market indicators such as moving averages and relative strength indices. Next, we will use technical indicators and charting tools to analyze the data. These tools can include trend lines, support and resistance levels, and candlestick patterns. Technical indicators are mathematical calculations that are based on the price and/or volume of a security, such as moving averages, relative strength index, RSI, and Bollinger Bands. Once we have identified patterns and trends in the market, we can use this information to make informed trading decisions. For example, if a stock is in an uptrend, we may want to consider buying that stock, while if a stock is in a downtrend, we may want to consider selling that stock. It's important to note that technical analysis is not an exact science, and that past performance is not always indicative of future results. Throughout this class, we will delve deeper into specific technical indicators and charting tools, and how to use them effectively in your options trading. Additionally, we will also be discussing how to use technical analysis in conjunction with other types of analysis, to make informed trading decisions. Let's begin our journey in understanding technical analysis and how it can be used to make informed trading decisions. Here are a few examples of commonly used technical indicators and charting tools. Moving averages. Moving averages are a type of trend indicator that show the average price of a security over a specific period of time. The most common moving averages are the 50-day moving average and the 200-day moving average. When the security's price is above the moving average, it is generally considered to be in an uptrend, and when the security's price is below the moving average, it is generally considered to be in a downtrend. Relative Strength Index, RSI. The RSI is a momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. RSI values above 70 are considered overbought and values below 30 are considered oversold. Bollinger Bands. Bollinger Bands are a volatility indicator that consist of a simple moving average and two standard deviation lines above and below the moving average. When the price of a security is trading within the Bollinger Bands, it is generally considered to be in a neutral trend. When the price of a security is trading above the upper Bollinger Band, it is considered overbought, and when the price of a security is trading below the lower Bollinger Band, it is considered oversold. Fibonacci retracements. Fibonacci retracements are used to identify potential levels of support and resistance by plotting horizontal lines at key Fibonacci levels, 23.6%, 38.2%, 50%, 61.8%, 100%, between a high and low point. These levels are commonly used to identify potential entry and exit points for options trading. Candlestick patterns. As I mentioned earlier, candlestick patterns are graphical representations of price movements over a specific period of time, and can provide information about the direction of the trend, potential reversals, and bullish or bearish sentiment in the market. Now we will review trend lines, support and resistance levels, and candlestick patterns. Let's start with trend lines. A trend line is a straight line that connects two or more price points and is used to identify a current trend in the market. A trend line can be used to identify an uptrend, a downtrend, or a sideways trend in the market. Uptrend lines are drawn by connecting a series of lower lows and lower highs, while downtrend lines are drawn by connecting a series of higher highs and higher lows. Sideways trend lines are drawn by connecting a series of similar lows and highs. Once you have identified a trend line, you can use it to make predictions about future price movements in the market. Next, let's talk about support and resistance levels. Support and resistance levels are key levels at which the price of a security has a tendency to stop and reverse. Support levels are the levels at which demand for an asset is strong enough to prevent the price from falling further. Resistance levels are the levels at which supply is strong enough to prevent the price from rising further. When prices hit these levels, they tend to bounce back, creating a potential buying or selling opportunity. Traders often use these levels to set stop losses and profit targets. Lastly, let's talk about candlestick patterns. Candlestick patterns are graphical representations of price movements over a specific period of time. These patterns can provide information about the direction of the trend, potential reversals, and bullish or bearish sentiment in the market. Some of the most common candlestick patterns include the bullish and bearish engulfing patterns, the hammer and hanging man patterns, and the morning and evening star patterns. Each pattern has a specific meaning, and by learning to recognize them, you can make more informed trading decisions. When reading candlesticks, it is important to understand how they form. The candlestick chart is composed of individual candlesticks that show the opening and closing prices, as well as the highest and lowest prices, of the asset during the given period of time. To read a candlestick chart, you first need to understand the basic components of a candlestick. Each candlestick is composed of a real body and shadows, also known as wicks or tails. The real body of the candlestick represents the range between the opening and closing prices of the asset, and it is typically colored white, if the closing price is higher than the opening price, or black, if the closing price is lower than the opening price. The shadows of the candlestick represent the highest and lowest prices of the asset, during the given period of time. The most important aspect of a candlestick chart is to look at the relationship between the real body and the shadows. The relationship between these two aspects can indicate the bullish or bearish sentiment of the market, and the size of the real body in relation to the shadows can indicate the strength of the sentiment. For example, a large real body and small shadows indicate a strong bullish sentiment, while small real body and large shadows indicate a strong bearish sentiment. It's important to note that candlestick charts are most effective when used in conjunction with other forms of technical analysis, such as trend lines, support and resistance levels, and technical indicators. Welcome to our class on paper trading. Paper trading is a great way to learn how to trade stocks, options, and other financial instruments without risking any actual money. It's a simulation of real-world trading, where you can practice your skills, test your strategies, and gain experience in a risk-free environment. The first step in paper trading is to set up a mock trading account. This can be done through a variety of online platforms, such as a stock market simulation or a virtual options trading platform. These platforms will provide you with a virtual balance of cash and securities that you can use to practice your trades. Once you have set up your mock trading account, you can begin to place trades just as you would in a real account. You can buy and sell stocks, options, and other financial instruments, and track the performance of your portfolio. It's important to keep track of your trades, and to record the details of each trade, including the symbol, the number of shares, the price, and the date. It's also important to have a well-defined trading plan, and to stick to it. This means having a set of rules for entering and exiting trades, as well as managing your risk and adhering to your risk management strategy. Remember that paper trading is a simulation, and it's not exactly the same as real-world trading. There are no emotions or psychological factors that can affect the outcome of the trades, which can be an important part of trading. It's important to use paper trading as a learning tool and not as an actual investment strategy, as the goal is to gain experience and improve your skills, not to make actual profits. Paper trading is a great way to learn how to trade without risking any actual money. By setting up a mock trading account, placing trades, and keeping track of your performance, you can gain valuable experience and improve your skills in a risk-free environment. The length of time that someone should paper trade will depend on their individual goals and level of experience. For new traders, paper trading can be a valuable tool for learning the basics of trading and developing a solid understanding of the markets. In this case, paper trading for several months or even longer can be beneficial in order to gain experience and become comfortable with different trading strategies, market conditions, and to develop a good understanding of risk management. For more experienced traders, paper trading can be used to test new strategies or to familiarize themselves with a new market or asset class. In this case, paper trading for a shorter period of time, such as a few weeks or even a few days, may be sufficient. Paper trading can be a great way to gain experience, test strategies, and develop a solid understanding of the markets without risking any actual money. Welcome to our class on mindset and behavioral finance. Understanding the psychological and emotional factors that can affect our trading decisions is crucial to becoming a successful trader. In this class, we'll be discussing the importance of having the right mindset, and understanding the behavioral finance concepts that can impact our trading decisions. First, let's talk about the importance of having a positive and growth-oriented mindset. Having a positive mindset means approaching trading with a sense of curiosity and a willingness to learn and improve. It also means having the discipline and patience to stick to our trading plan, even when things don't go as expected. On the other hand, having a negative and fixed mindset can lead to making impulsive decisions, and giving up easily when faced with challenges. It's important to be aware of these negative thoughts and to actively work on replacing them with positive, growth-oriented thoughts. Next, let's talk about behavioral finance. Behavioral finance is the study of how psychological and emotional factors can affect our financial decisions. One of the most common behavioral finance biases is the tendency to be overconfident. Overconfidence can lead to taking on too much risk and making poor investment decisions. Another common behavioral finance bias is the tendency to be anchored to a specific price or value. This can lead to holding on to losing positions for too long, or missing out on potential gains by not selling at the right time. To combat these biases, it's important to have a well-defined trading plan and to stick to it. This means having a set of rules for entering and exiting trades, as well as managing our risk and adhering to our risk management strategy. It's also important to be aware of our own emotional and psychological state, and to actively work on developing a more objective and rational approach to trading. One of the most common and difficult aspects of options trading is dealing with and avoiding revenge trading. Revenge trading refers to the tendency of some traders to make impulsive and emotionally driven trades in response to a previous loss, in an attempt to recoup the loss quickly or to get back at the market. This type of behavior is often driven by feelings of frustration, anger, or disappointment, and can lead to poor trading decisions and increased risk-taking. Revenge trading can be dangerous because it often involves disregarding a trading plan or risk management strategy, and making trades based on emotions rather than sound analysis. This can lead to overtrading, taking on excessive risk, and potentially losing even more money. It's important to remember that trading is a game of probabilities and no one can win every time. Losing trades are a natural part of trading, and it's important to have a plan in place to deal with them. One way to do this is to have a well-defined risk management strategy, which includes setting stop losses and taking profits at predetermined levels. This can help to limit the potential loss on any one trade, and prevent impulsive behavior like revenge trading. Another way to deal with losses is to take a step back, to reflect on what went wrong, and to learn from the experience. This can help to develop a more objective and rational approach to trading and to make better decisions in the future. In conclusion, revenge trading is an emotional response to losses that can lead to poor trading decisions, increased risk-taking and losing even more money. It's important to have a well-defined risk management strategy in place, to stick to it, to reflect on what went wrong and to learn from the experience, in order to avoid the negative effects of revenge trading. Welcome to the conclusion of our course on options trading. Throughout this course, we've covered a wide range of topics, including the mechanics of options trading, risk management, technical analysis, and mindset and behavioral finance. First, let's review the key takeaways from the mechanics of options trading. We learned that options are contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price, known as the strike price. We also learned about the different types of options, such as call options and put options. Next, we covered risk management and how it's crucial to avoid losing all of your money while trading. We learned about the importance of setting stop losses, diversifying your portfolio, having a well-defined trading plan, staying informed, and being aware of your own risk tolerance. We also learned about technical analysis and how it can be used to analyze and predict option prices. We discussed trend lines, support and resistance levels, and candlestick patterns, as well as specific technical indicators and charting tools, and how to use them effectively in your options trading. Finally, we discussed mindset and behavioral finance, and how understanding the psychological and emotional factors that can affect our trading decisions is crucial to becoming a successful trader. We learned about the importance of having a positive and growth-oriented mindset, as well as the common behavioral finance biases such as overconfidence and anchoring, and how to overcome them. I want to take a moment to thank all of you for attending this course on options trading. It has been a pleasure to share my knowledge and experience with you, and I hope that you've found the information and insights that we've covered to be valuable. Trading options can be a complex and challenging endeavor, but by understanding the mechanics, practicing proper risk management, utilizing technical analysis and staying aware of the mindset and behavioral factors that can affect our trading decisions, we can increase the chances of success. I hope that you've found the course to be informative, engaging, and that you've been able to take away some key concepts and strategies that you can apply to your own trading. Remember that the learning never stops, and it's important to keep yourself informed and up to date with the latest market news and events. Once again, thank you for attending this course. I wish you all the best in your trading endeavors, and I hope that you'll continue to learn and grow as traders.